Hello, everybody. Welcome to our first Q&A with me, all about property. Now, this could be something that is very short if nobody turns up, or we could be here for a while. So, if there are anybody out there, give us a shout, leave us a comment, let me know you're there, and then we can start talking about property investing, what you want to do in your lives to make yourself financially free. So while we're waiting for people to join us, Happy New Year and welcome. For those who don't know me, so I'm Steve Potter. I'm a property investor, that's full-time property investor now. I started in 2019, and when I started, I had nothing. I was living in rented property after a divorce, and didn't have any money behind me, didn't have any property. But I just wanted to start in buying property, and I was allowed to buy buy-to-let properties through mortgages, and that's what I did. So in 2019, I bought 2 properties for buy-to-lets, and it was okay, not the greatest, but we got to COVID. And I started looking at different ways of investing in property. And I found lots and lots of people selling courses, lots of people telling us all about different strategies. And I went on a course and learnt, and then turned my portfolio from 2 properties into 1.3 million in 3 years. Now I specialize in using other people's money. So even now in 2025, it's been, well, getting on for 5.5, 6 years. I still haven't spent more than £20,000 of my own money, but I do have a big portfolio. I own 5 property companies with my wife. Our daughters, we have 5 daughters between us. 4 of them work for us in our properties, in our property companies, and they all have housing, and they all have employment through our property business. So property has completely changed my life and my family's life. It means I no longer work as an employee. Excuse me. I officially retired from being an employee at 52 in year 4, and now I do my passion. I enjoy working with building my own portfolio. I enjoy working with people, other landlords, other investors, helping them get the most out of their property. And with the Property Legacy education that we started last year, we have our podcast, our books, and now coaching programs and mentorship programs and all those kind of things. So this is free for anybody to turn up and ask questions. Obviously, maybe people don't turn up. So from time to time, I'll do an education slot. But at the moment, we'll see what happens, see where we go. So I have a question that was provided to me earlier by Rachel, who's on one of our WhatsApp groups. And she wanted to know, she wanted to ask about remortgaging a buy-to-let, and this is what she asked. So I'm looking to remortgage a buy-to-let to set me up on her property journey. What are people going for in fixed rates? Is it 2 or 5 years? Plus, should I leave 30% in the property, enable a better mortgage deal, as a property is in her name, and one of the goals is to pay the mortgage off in the long run? And any advice and thoughts would be gratefully appreciated. Thanks, Rachel. So as I said to Rachel, it's a great question for tonight. And yeah, the situation is remortgaging to release some equity that's built up is a great way to generate money to buy the next property. And it allows her to release cash that's already hers, so there's no tax implications releasing cash, just by remortgaging. So at this moment in time, interest rates are fairly low, not as low as it has been in the last decade, but lower than it was in the 80s and the 90s, when we had 15.5% interest rates. But inflation is low as well, lower than the target 2%. So we could expect that the government will, or the Bank of England will reduce interest rates again over the next 6 months, maybe a little bit longer. So I'd suggest if she wanted to go for a fixed rate, then go for a short fixed rate. And then if the interest rates start to increase over the next 2 years, as inflation will rebound back up again, then that's the time to get a longer fixed rate to protect us from that. But for the meantime, now's the best time to get that done, because the interest rates are low, and house prices are very low compared to what they've been like for the last 2 or 3 years. The market is recovering and will increase with the new mortgage interest rate reductions that will happen, and properties will start to go up in value. So now's the time to buy. Now's the time to get all your cash available to invest. Now, whether she should keep it at 30% or not, well, my advice is to, first of all, go for a remortgage. So on average, it's 25% deposit to 20%, depending on the deal. But more often than not, it's 25%. So your deposit you need to have in it, or equity you need to have in the property. So you should have to go for a 75% loan to value. Now, when you go for a remortgage, the mortgage company asks you how much you think the property is worth, and then they base that on and they go and value it. And if you agree, that's what they'll offer you, 75% of the mortgage. So at the end of the day, you could tell them any figure. You could say it was £150,000 house. I know in some areas of the country that's very small, and some areas it's quite large. So 150,000. And if you turn around and said it's worth 180,000, the bank would either agree with you and give you a loan to value of 75% on 180,000, or would say, oh, well, we think it's worth 165, 160. But by doing this, you open yourself up to actually getting more of a value, and then a higher value than you thought you would, which means then you'd be able to release more cash, which then means you'd be able to go and get more properties, or be easier to manage the one you want to buy. Or you can then ask to reevaluate the mortgage and bring the interest rates, the loan to value down to 70% or even 60%, so that you can get lower interest rates again. And that's something that a lot of people fail to do. They think you have to tell them what you think the house is worth, and they don't think you can then add any information, add to the value itself, with a view to thinking you get more than you think it's worth. The other way around, if you tell them it's worth 150 and they snap your hand off, then you're always going to wonder whether you could have actually said it was worth 160, 180, 200,000. You just don't know. So why not play the game? Increase your value a little bit. See what they say. If they say it's too much, they'll tell you what they think it's worth, and you can make that decision. But if you start off low, they can only knock it down lower. So from Rachel's point of view, now's a good time to remortgage. The interest rates more than likely will drop over the next 12 months, but will start to increase again over the next few years. So just be careful of that. And over time, any deals you have will get better and better in property. And also, when you're looking to revalue your house for a mortgage, don't necessarily believe what you get told. Just put your figures forward and they'll either agree or disagree. And it's not skin off your nose if they give you extra cash. Okay. So, this being the first, obviously it's not going to be the best format, or you're going to have lots of people following us. But we actually do have a comment. So, Rachel Brown. So you're saying that I should say my buy-to-let is worth 350 when I believe it's worth 325? Yes. Because the worst thing that can happen is they turn around and go, no, actually, it's worth 325. You're getting what you wanted. But if you said it was worth 325, they could come back and say, oh, well, actually, we're thinking it's 315, and you're not going to be happy. So if you put it up to 350 and then they agree, then you're going to get the extra cash in, or you can then turn around and say, well, let's readjust it. I want to leave 30% equity in the property. What deals can you give me then? And they'll probably offer you a smaller percentage. And if that is the case, then you've got the best of both worlds. You got the money you wanted and a better deal. Or vice versa, if they say, yeah, it's worth 350 and you get more out, or you double your money left at the end of the deal once you paid off your last mortgage, then it means that either you're going to have less money in the deal, so it's a no money down deal, or you're going to be able to go in there, do a better renovation or do a flip and change what you want to do. Does that answer your question? Has anybody else got any questions? Oh, I'm slowly getting used to pressing all the buttons. Yeah, great. Thanks, Rachel. Has anybody else got any other questions, or is there actually anybody else there? That'd be fun. Just put a comment of yes, just to show that there are other people. No, I'm not just talking to Rachel. We could have done this on the phone, Rachel, if it's just me and you. So in future weeks, we're going to be talking about how to analyze deals. We're going to be talking about how to spot good deals. What do you do if you need to find an investor? What you're going to do across the board to make your property investing better all around. So Samuel is somebody that I've been talking to over the last couple of weeks. So how does the mathematics work in refinancing? Okay, so so the mathematics in refinancing. So normally, if you're doing the buy-to-let mortgage, you would put down a 25% minimum of 25% deposit, or if you're remortgaging a property, you need to leave in at least 25% equity. So part of your deal. So the maximum of buy-to-let you probably get loan to value is 75%. So on £100,000 property, and yes, there are properties available in the UK for £100,000, you would be able to get a mortgage of £75,000, and you'd have to put a deposit in of 25%, 25,000. Now, if you're remortgaging, you tell them that the value of the property is £100,000, they would then be able to give you £75,000. And you would do this and repay the last mortgage with that 75,000, and you'd keep the change. So on a remortgage, say you bought the original house for 72,000, and you added value, you renovated the property, and after a year it is worth 110. So you've got equity in the property. So you bought it for 72. Your mortgage is around about 57, 58,000. So with the new valuation, it's actually worth double. So you're on 50% loan to value. And if you went to remortgage, you could then turn around and say, right, I want to remortgage at 210,000, or if you follow my advice, I'd say 115 or 120. And they would confirm whether they agreed with the valuation. Now, they would give you 75% of the new valuation. So that would be in the region of about £85,000, which then you'd pay off the £57,000 mortgage and you keep the change because that's your equity. So 57 to 85 is just less than 30,000. And you could take that 30 less than that money and go and put it down as a deposit, 25% deposit on another property. And then add value, and then you just keep going along and along and along. And this is all about following the BRRRR strategy. So you'd buy, refurbish, or add value. You'd then rent it out and refinance to get your money back out, so that you can then take that money and go and invest it elsewhere. Does that answer your question, Samuel? Hello, Adam. I can see you there as well. It's getting busier than I thought it was going to be. So yeah, so Adam, it's here, seeing what these sessions are all about before signing up for coaching. Have you got any reviews anywhere for current clients that we can talk to? Well, you can we can go and have a look at the YouTube. So if you go to our YouTube channel, Property Legacy, the podcast, and look in series 2, there's an episode where we talk to Demi and Nick. They joined us for our one-to-one coaching year last November, and they didn't think they could go and buy a property. They didn't think they had enough money, and after some coaching and some education, they realized they could then go and buy a property, which they did last February. And they then added value, they renovated it, they did a lot more than I said they should, but they kept it to within their budget. And now they've got a nice 3-bedroom property that they rent out for £850 a month. Which is bought it for 99. So it's a good return. They've got a nice tenant in there. I think the tenant actually paid for some of the carpets and lighting and things like that. So it's a really good tenant. And now they're looking at their next property. They're actually got an offer in at the moment. We were just talking today, got the survey done. Just umming and ahhing whether there's too much work with that one property or whether they need to move on. But yeah, we can definitely, you can watch that, see what you think, and then once you're in the membership, they are part of the membership group as well, and you'll be able to chat with them there. But yeah, hope you enjoy tonight. See how many people come along and ask questions. But so thank you for popping along. It's the first one we're doing this way. Normally we do this behind closed doors and have meetings and do them every so often. My background seems to be playing up, but hey. Right. So Samuel, yeah, you understood that. Okay, so Samuel's come back with a follow-up question. Does that mean my interest rate will go up when I refinance in a new property value? Now that depends, Samuel. If you're currently paying 6% on your interest rate, and you've got a new mortgage today, on average, you'd be able to get 4.5 to 5%. So it would go down and your interest rate would go down. Doesn't mean that when you refinance, you're always going to be paying more interest. What you might be doing is paying interest on a higher amount mortgage, but that then would release cash that you'd reinvest and make more money with it. So as long as you make money, that's what you do. Obviously, the interest rate could be lower, it could be higher, depends on what deal you have. But if you're getting a higher loan amount and you're getting 75% of a higher amount, you will be paying more per month. But when you put that against how much that would then allow you to go and achieve in a new property, it should counteract that. So you've got more money coming in. You got two properties in, and you'll then be able to operate them at a profit. Does that make sense? Still trying to get rid of this cough and cold. It's painful. Does anybody want to actually come on the screen and talk? If you do, let me know. Stick your hand up. Send me your WhatsApp number and I'll send you a link. Rachel Brown. I'm looking to increase my income as quickly as possible. Would you advise a hands-off approach to buy-to-let or flipping to start off with? Right, Rachel. So if you're looking to make income as quickly as possible, does that mean cash flow each month? Or is that going to be you want to do a flip and 50, 60,000 or 100,000 in one deal? But that deal could take you 6 to 12 months to do. So you could look at it from two different options. You could take a property and do service accommodation, which means you would, instead of just renting out to a single family, you would rent out per night. And obviously you could earn more money doing that, depending on the property, depending on where it is. Obviously with flipping, you would do the property up, add the value, and then sell for higher. Now, at the moment, obviously the market is low, so it's a great time to buy. You can't guarantee the market will have increased a lot by the time you get to the end of that flip. So what I would do would think of an approach of, if you find a property that would work on a flip, then that's fine, go for that. But have a backup plan of a BRRR and a buy-to-let. So how does that work? So effectively, you would go with a flip. So say you're buying a house for 200,000 and the house next door is just sold for 350. So there's loads of space. So it needs doing up, needs work doing to it. If you get it for the 200 and you spend 50,000 on it, you could sell it for and have 100,000 profit in 1 year. Now the problem with that is obviously you're going to get taxed on that, so you'd have to make sure that you have a way to understand where you're going to spend that money, how you're going to protect it from tax and all the rest of it. Speak to your accountants that will advise you on that, or your tax advisors. But that's a good way of going forward. You would get a big chunk of cash, and then you could go and buy two properties with the deposit, depending on where you're trying to buy the properties. Now, if the market, when you try to sell, isn't good, perhaps the value's only gone up to 260 or 270, you could sell and get your cash back out, your renovation cost back out, and you have a small profit, but you might not. So what you could do, if you have the BRRRR in the background and the buy-to-let, you could then refinance it to get all your money back out and rent it for the next 6, 8 to 12 months or even 2 years while the market properly recovers. And then you could then sell the property after 2 years or so for the 350, the 450, whatever the price will be in the next few years. Obviously, whenever we're talking about property prices and growth, we always go back to 1952, where everything was started to be recorded on the average house prices in the UK. And on average, obviously there's peaks and troughs and ups and downs and recessions and booms, but on average, 8.1 years to 10 years, property values double. But that's not every area of the country. Some areas work better than others. Some areas don't work well at all. So just take that into account. If you're doing a flip, always have a backup and always have a strategy that you can fall back on, that you know no matter what, that will still work, still give you money, and it will still bring cash flow in. And if you've got a property that's in the region of £250,000-300,000 house, then your rent coming in will have a good cash flow on that. But it's something to bear in mind. You could do a flip, then a buy-to-let, flip and buy-to-let, and make money that way. So you get good cash flow up front, and then you reinvest it. But obviously, if you need to earn income, then you won't have as much money to invest in the next property. So just be careful on what you're trying to do. You try to keep your hands off all the profits for as long as possible and keep reinvested until there's a bigger business to work with. So Rachel, does that answer your question? Okay, so Samuel, thank you for your response. Would you consider repaying the mortgage to fully own the property, or would you prefer to continue with interest-only payments? Seems like a lot of hassle to manage multiple properties, and you can never be sure if you'll find reliable tenants. It can be quite stressful to own several properties. Okay, so Samuel, yeah, there can be stress in it, but as Rachel said, she wanted hands-free, hands-off investing. So what that means is that you would invest, you buy a property, you would get a managing agent to manage it for you, you'd get somebody to project manage the renovations, and effectively you would just be sat there at the end of each month getting an income. That's hands-free, hands-off. So that way you are not managing your properties. That way you're not managing the day-to-day of the portfolio, and it doesn't interfere with your family life. It's just cash coming in. Obviously, if you wanted to manage it yourself, then yeah, it could become a full-time job for you, managing the portfolio, and you got the ups and downs of dealing with tenants and dealing with people and stresses and strains of the property management. If you talk to any property manager, there are ups and downs, but the majority of the time there's more ups and downs. Just depends on your tenants. Obviously, you do your background checks, you do as much due diligence on your possible tenants before you allow them to move in, and you work with them to make sure that you get the most out of the relationship as possible. And I don't mean that just to get money out of it. I mean to have a good relationship with tenants so that they know you're looking after them, they're looking after the property, and it's a partnership. It should be a partnership between the landlord and the tenant. So if you're thinking that dealing with people and dealing with properties and dealing with maintenance is all too much of a stress, then you should look at doing this hands-free. And to be honest, unless you're good with DIY, you would have to use contractors for renovations. You would have to use contractors and electricians to get the certificates all done. So you're going to have to create a team of people that works with you, whether you do it yourself or whether you have an agent. You still need to know the people that are there. So would you consider repaying the mortgage? Well, if you had one property and you repaid the mortgage, then yeah, you would have more profit per month. But because you've just got the one property, you then have a lot more risk for voids, a lot more risk for a problem tenant. Whereas if you had multiple properties, like 3 or 4, and you had a void, so a void means a property is empty and you can't rent it out until you've done a freshen up or a little bit of a renovation, or there aren't as many tenants, or you can't find somebody that passes the background checks. It just means then you've got a property that's not bringing any cash in. And if you need that income, then you've got a problem. Whereas if you've got 3 or 4 properties that are all bringing in money each month, and one isn't paying out because there's a void, then the others support that, and the others can help pay that mortgage or pay that income, so you don't feel the strain as much, and it protects you from any of these ups and downs. There are going to be cycles. There are going to be areas of the country that people move every 6 months. Other areas where people get a property, rent it, and they're there for 10 years, 20 years. They're there for however long they want. It just depends on who you get. So if you pay your mortgages off, you'll get more profit, but your money is locked in that property, and you could the only way you could use that money is if you sold the property or you refinance the property to then go and buy multiple properties. So it's up to you, but it's with property investing, generally you would build a portfolio of multiple properties, and then over time pay back these mortgages to bring them down, so that the mortgage values are going down and down as you repay that over years. And that way, eventually, all the properties will be 100% yours, and all the money coming in would be 100% yours. So I would, if you're younger, I would invest in a few properties, 4, 5, maybe 6 properties, or even get to 10, and then start looking to drive those mortgages down, because that then means that all the profit coming in is yours. Obviously, tax implications and things you'd have to take on board, but for a period of time, you would build your portfolio and then you consolidate it. In my point of view, I'm building a portfolio and keep building and building and building. So I will continuously keep building and not pay them off. Right. Okay. So, Rachel, are lease properties worth having, or is a freehold property better? Well, if you're got an apartment, majority of apartments are leasehold. Just because there's multiple properties within one building, so there'd be one freehold for the whole building, and then each flat or apartment would be on a leasehold. They do seem to be using more leaseholds on detached properties, semi-detached properties, new houses. Obviously, the property developers have realized that if they do leasehold, people still buy them just as much as they would do if they were freehold. But people don't really think about the fact that, well, yeah, you might have a lease for 100 years or 1,000 years, but eventually, if you don't get a new lease on it, it's not yours anymore, even though you spent all this money on it. So ideally, I would always try and get a freehold property. But if you're going for apartments, you'd struggle to do that. But you can at some point buy the freehold for the apartment block, and own the freehold. So you could work on that. Some investors just buy freeholds. They're not that expensive compared to the value of the building, and you would get the ground rent paid to you from all the leaseholders. for the year. So it's something to think about. But if you're buying kind of houses, then I would look to get freeholds. Leaseholds can be restrictive. Sometimes the leases don't allow you to sublet. So effectively, because you've got a leasehold, you're treated as a tenant, not a homeowner, as far as the lease is concerned. And from that point of view, it means then that you'd have to pay ground rent, which you do. But if they say that you're not allowed to sublet, means you wouldn't be able to use it for to rent it to anybody else. You wouldn't be able to do service accommodation. You definitely wouldn't be able to do HMOs and all these kind of restrictions in there. So you'd have to be a little bit prepared for that and make sure that you read the lease and understand what restrictions that there are. But wherever possible, always buy freehold. Then you own the property. Leasehold, there's obviously the government have been looking at changing the rules around leaseholds and giving leaseholders more leverage against the freehold owners, but that's still going to be an issue for some time. But I'd always try and buy freehold property. Okay. So Samuel, he says, I have a feeling that the market is now saturated in places like Blackpool. Councils are not allowing service apartments permission, which makes me feel like we're a bit late to the game, especially in Manchester. As a beginner, I feel like I'll be battling against seasoned business experts, which makes me feel somewhat hopeless. Oh, Samuel, it's not hopeless. When you look at the scheme of things, yes, there are restrictions being put in place. There are restrictions for HMOs, restrictions for service accommodation. Doesn't mean you can't do that. It just means you have to make sure you get planning permission to do that and put them in the correct places. The reason why councils are restricting where service accommodation can be positioned is during COVID, we had the staycation, and a lot of buy-to-let owners changed their buy-to-lets to service accommodation overnight because of the staycation. Needed a lot more places for people to stay, and they could make a lot more money. So they could rent out their property for one night for the same price they'd rent out normally for a whole week, and in some areas even higher. So they moved a lot of the properties that were buy-to-lets, disappeared off the market, and became service accommodation overnight. Now, this happens all over the country, and quite often people suddenly found they had a service accommodation party house in their little cul-de-sac in their housing estate, miles away from anywhere else. No tourism attractions or anything like that. And there was noise issues and all this kind of stuff. So councils got a bit annoyed with it, got a bit peed off with it all. And the government put in place as of this last summer that now you need to get planning permission to make sure you fit in for the zoning areas of your local council. So I live in Blackpool, and as Samuel mentioned, there are restrictions of service accommodation in Blackpool. That's mainly because there were 500 properties that used to be it used to be buy-to-let, suddenly became service accommodation overnight, and they're in the wrong place. So Blackpool Council are issuing cease orders to stop business as service accommodation, so that it realigns everything the way it needs to be put, so that it fits better with the council's plans, it fits better with the zones, so that tourists and tourism are kept together, your commercial areas are kept together, your residential areas are all separate from tourism, so you don't get that friction between the different types of people using the area for different things. You wouldn't want to have a residential house in the middle of the pleasure beach. Some might, but generally you wouldn't. So it's all about making sure you get the right houses, the right businesses in the right areas, so that everybody is happy-ish, happier. So yeah, and you're feeling like you're a bit late to the game. Well, yes, you're late as if you're looking at what happened in COVID. You're late if you're looking at what happened in year 2000 or the 80s, or the fact that when I said before that the interest rates were 15.5%, and I bought my first house in 88, 89, something like that. But we are on an island, and there is only a certain amount of space and available. The UK has always been an area where people aspire to own their own houses, whereas on the continent, in the States, there's a lot more. The 80-20% rule tends to be 80% of the people rent and 20% of the people own. In the UK, it was a lot more in the favor of people owning their houses. But over the last decade, 2 decades, it's starting to get to the point where people can't afford to buy. Prices are going up, so that, but not in line with people's income. So it means that people are now renting more, which then generates a bigger demand for rents, which means there's a bigger demand for us to be buying properties and giving them as rented properties. Each year for the last 10 years at least, the government had a target of 300,000 houses they needed to build every year, and every year they didn't hit it. So to keep up with population, they were saying population growth, they were saying they were having to build 300,000 houses, and they never hit that. Not even with all the investors, not even with all the property developers, all the big companies that build housing estates, they didn't hit 300,000. In the last general election, all the parties dropped that target down to 200,000. Mainly because they want to show that they can actually hit a target now and again. They may not hit that target because they've strengthened the regulations around where you can build and where you can develop, and planning's got harder. But it means that no matter what, there is a strong demand for housing in the UK. There's not enough. Prices will keep going up because of that, but there's not enough houses being built to help out. So whether you get on the ladder today, get on the ladder next year, you will still make money in property, because it'll just continue and continue and continue to get more and more expensive to have properties in the UK. So the sooner you can get onto the property ladder, the better. There's never a good time. There's always what are we going to say? So doesn't matter when you start, but you can only start today. You can't start tomorrow. You can't start last week. You can only start today. So if you're going to start, then get started and work towards that. But it's going to take time. It's not something that happens overnight, and it takes time. So let me see again. Right, how does the planning permission process work? And in your opinion, where is the best place to invest right now and why? Well, the north of the country are where the cheaper houses are. And so the northeast, the northwest, there are cheap houses. So for an example, I'm in Blackpool. You can get a 3-bedroom house for 60 or 70,000. You need to renovate it, but you can get a 3-bedroom house for 60 to 70,000 pounds. You can then rent that out for 800 to 850 pounds per month, and generate on average over 10, 12% gross yield per year. So that's where it's better. Obviously, if you've got the money, if you've got £500,000 to go and spend on a property down in the southeast, then when your value of your property doubles every decade, then you'll be a millionaire in within the next 8 years. In the north, you'll be able to take that money and buy multiple properties, and then so that reduces your risk or spreads your risk out. It then allows you to have multiple income streams coming in, and would actually make you more money because your return on your investment would be higher because of the gross yield would be higher. In the southeast, London, you'd be looking at 3 to 4% gross yield. In Blackpool, it's got some areas in Manchester, even 11 to 12% gross yield. So you can imagine you can earn more in those areas. Now, the planning, effectively, all you've got to do is you would put your planning application form in for service accommodation, an HMO, or whatever you wanted to do, whether you're going to extend, whether you're going to build a new house on a plot of land. You put a planning application form in, and as long as it hits all the requirements for that particular council or that particular planning office, they would give you the go ahead and the planning permission. Now, saying that, it does take time. It can, the property we bought in the 16-bed hotel we're converting at the moment took 9 months to get planning. So it can take a while. So what I would do if you're doing planning, you would go through a planning agent or an architect that deals with planning, and they would handle all that for you. And you would pay them to do the drawings, so the plans are there, and then put the planning permission in. Once you get the planning permission in, you then need to build or do what you're going to do to the property and make sure it's up to the building regs. And you will get building standards inspectors from the council coming around to check it and make sure it's all above board. It should be very simple, as if you're working with an architect and knows what the council will allow, and it fits in what you're trying to do, and you work your plan to fit around it, it should all work seamlessly and like clockwork. Should. Doesn't always. No. Our planning permission took 9 months because they wanted us to plant 3 trees. That was it. Not the fact that we're converting a 16-bed hotel into office suites. That didn't make any difference, except they did ask why we're putting bathroom suite, shower room in each office suite. And obviously it's because when we rent these office suites out to businesses, they'll have cycle to work schemes, walk to work schemes, and they'll need to have a shower. Nothing to do with the fact that they may or may not become apartments one day. Who knows? But okay, does that answer that, Samuel? Sorry to hijack the chat. Samuel's feeling sorry already. Right, what are we saying here? And with a million questions, what factors are you considering when buying a house in the north and south? It doesn't matter where you buy a house, you're looking at the similar kind of factors. If it's an investment, your main factors you're looking for, is it a good area to rent out, or is it a good area that's going to give you a good return? If you're investing in property, you want a good return. Whether you're investing in stocks, you want a good return. When you invest with precious metals, you're looking for a good return. That, no matter where you are in the world, that is what you're trying to do. And your return on your investment is a positive amount. If it's gonna mean that you don't have, that you're spending more on the mortgage than you would do coming back in on a rent, then don't do it, because why would you pay money to have a property that you lose money on? So the whole point, whether you're in the north or the south or America, Australia, wherever, if you're investing in property to make money, then you need to make sure that the the deal stacks up and you make money. The only difference for the areas are the fact that there's more zeros in the mathematics. That's it. It's still a property. It's still got X amount of bedrooms or bathrooms, or if it's got a basement, or if it's got garage, or if there's off-street parking. All these factors fit in. But wherever you are in the country, it just states the prices for where you are the prices where you are. So it may be cheaper and easier to invest in an area away from where you live because there are cheaper properties away from where you live. Samuel, I know you live near Reading or in Reading, and prices down there are a hell of a lot more expensive than they are in Blackpool or the Northeast or Morecambe or those kind of places. But if you can get to the point where you do rent to rent, or you do purchase lease options, or you're doing working with an investor, or you get 100% bridging loans which are available, and you buy a property in Reading, then your rents are going to be a lot higher. So your cash flow will be a lot higher. The possibilities for capital growth will be higher as well, because a 10% on a $500,000 is a lot bigger than a 10% on 70,000. So it's still the same percentage, but the value is higher. So I wouldn't worry too much about where you live and about what the difference of thinking about where to buy houses. You literally look at the area that you choose to be your catchment area. You look at what areas are in demand for rent, what areas are cheaper for housing. Always look for the worst house on the street. Buy the worst house on the street. One, everybody else in the street will think you're wonderful, because you will renovate the property the worst on the street, and then the whole street will gain in value. So you need to be on the lookout for properties that are empty, properties that need work, properties that just don't look as nice as everybody else's, because you'll be able to buy it cheaper, then you'll be able to renovate it or add value. You could see that all the houses on the street are all 5-bedroom houses because they've extended over the garage, or they've even got a garage. Whereas the one you're looking at is just a 3-bedroom house with no garage, no extensions. So you can see clearly that you'll get planning permission because everybody else has done it. And you'd be able to add value to the property and be able to sell the property for the value that everybody else is selling it for. And that is mainly the things you work on, the things you look at when you're investing. It doesn't matter whether you're in London, whether you're in Aberdeen, whether you're in Blackpool or Newcastle upon Tyne. You still look at the areas of where people want to live. You still look at the areas that are cheaper, more expensive, and you go through the figures and make sure that at the end of the day, you will make money. And you have enough properties to do it, you'll be wealthy and you'll be financially free. That's the whole point. So does that answer your question? Okay. So Samuel's saying, worst nightmare is owning multiple properties without tenants for several months. If that happens, I might struggle to pay the interest-only mortgage and end up losing everything. So I'm worried. I'm also worried about of the potential consequences. We'll go to prison or end up in bad credit record that prevents me from getting a loan in the future. Okay. So you wouldn't go to jail unless you committed fraud. Now, you wouldn't do anything that's fraudulent. Our conversations we've had, that's definitely that's not something you would do. It's not something I would do. And I wouldn't condone anybody doing fraud. So you wouldn't go to prison. You might end up owing people money. If they're on the worst case scenario, you might go bankrupt. Now in the UK, that means that you're bankrupt for 12 months. It stays on your financial record for 6 years. And then after that, you're free again. You can go and get a mortgage. You can go and get loans. You can do whatever. The government set up IVAs and bankruptcies purely to assist entrepreneurs and people taking a risk to go and get property, to go and build businesses, companies, to invest and grow the economy and be able to take that risk. So you take that risk, whether you're suddenly going to have a business where you're going to go and live on Mars, or you're going to build a different version of the Tesla. It's always a risk. You put your money in and you work hard, but most companies in the first year fail. And most of the companies that survive the first year fail in the next 5. So the worst case scenario, is that you have multiple properties and nobody wanting to rent them. But if that happens, the worst case scenario is the very worst case scenario. You would hand your keys back to your mortgage company. They would sell the properties off, recover what mortgage was outstanding, and that would be it. You'd be embarrassed, you'd be a bit hurt, but you'd learn a hell of a lot, and then you'd start again. You never fail until you actually stop. It should always keep going and going and going. Now, if that's something that you feel is too much of a risk to take, it's not for you, then don't do property. Do not invest in property if you don't feel you can take that risk. But also, don't invest in crypto and don't invest on the stock market if you can't stomach losing all your money, because you will run the risk of losing all your money in all those kind of investments. If you leave your money in a bank account and you're getting 3%, say, interest rate, and everybody's saying, "Oh, just leave it in the bank; it's safe." But if inflation is at 5%, then actually you're losing money. Your money is worth less than it was the year before, each year by 2%. It doesn't increase; it just keeps getting less and less and less of a value. All the governments around the world print money every single year. So the value of the £20 note gets less and less and less through inflation, through the fact that there's millions of £20 notes available. If there was only 2,000 £20 notes available, they'd be worth a lot more. They'd be very valuable. People would stick them in a frame and frame them and put them on the walls, have them as art and things like that. But just because there's such a lot of them, they're only worth £20. But £20 now doesn't buy you as much as £20 in the 80s. So it might be your worst nightmare. But if you want to become financially free through investing, whether it's stock market, whether it's gold, whether it's property, then you will have to take a risk. And if you're not happy taking that risk, then Samuel, don't start it. Don't go. Do what you're happy with. It's a different mindset for a property investor or a entrepreneur. And you need to be honest with yourself. If you view things and see just a load of nightmare and a load of problems, then perhaps it's not right for you. But yeah, if you want to have a chat about that, we can have a chat anytime. Right. So I seem to be talking for ages. Anything else? These properties worth. That's Adam saying perfect. Thank you. Samuel saying thank you. Yes, we're just seeing what else the sessions are all about before the signing. Yeah. So I think that went rather well. It'd be good if people could let us know, give us some feedback, leave us a review. Yes, Samuel, it is being recorded. So at this moment in time, it's streaming into Facebook, it's streaming onto my LinkedIn profile. It's also streaming to our Property Legacy, the podcast YouTube channel. And I will keep all the recording on the YouTube channel under in its own little section. And each week we will do this and put a recording on there. We might take out some of the ums and the ahs and edit it a little bit, but we will record each of these sessions so that even if you can't make it, you can always watch it and hopefully learn from it. I would love to listen to you again. Okay, thank you, Samuel. Rachel Brown, thank you for all your advice. But I must go now. See you again soon. Yeah, Rachel, I think I can't keep going. My voice is going a little bit and I'm coughing a little more. So I'm going to, unless there's anything suddenly pops up on the screen, I'm going to call it a day. And thank you. Thank everybody for turning up. Samuel, thank you very much. Adam, thank you very much. And Rachel, thank you very much. Hopefully we'll get more questions this time next week. Start saving them up. Tell everybody about this if they think that it'll help them. And hopefully we'll grow the channel. Hopefully we'll grow the podcast we do. And let's face it, it's free. I sit here talking about property, which I love doing. And I also learn from the questions you also ask. So this has been good for me. I hope it's good for you. But for today, thank you so much for being here. And I'll see you next week.